Patricia had been married to David for 41 years. David was an engineer. He opened the IRA, set up the automatic investments, managed the Medicare choices, and kept track of what was where. Patricia had a general sense of where they stood, but the details were David's world. David died in February. By April, Patricia was sitting across from a financial advisor she had never met, looking at a stack of account statements she didn't recognize, holding a list of decisions she wasn't sure how to make. She told me later, "I wasn't incompetent. I ran a household, I raised 2 kids, I worked. I just never touched that part of our life." Patricia is not unusual. In 2 out of every 3 married couples, one person handles the majority of the financial work. In most of those couples, it is the older partner, statistically more likely to be the husband. Which means millions of surviving spouses, mostly women, are handed a financial learning curve at exactly the moment they are least equipped for it. If that is you, or if you are the one who handles the money and you are watching this so your spouse won't be lost someday, you are in the right place. Nothing here requires you to become an expert. It just requires you to take the next small step in order. This episode is for Patricia, and for everyone sitting where she sat. We will walk through the first 90 days, what to secure, what can wait, and what to never sign before you are ready. For the first 3 days, your only financial job is to gather and protect, nothing else. Don't sell anything, move anything, or sign anything except what a hospital, funeral home, or court actually requires. 3 tasks matter in those first 72 hours. 1. Locate the death certificates. You'll need more than you think. Order at least 10 certified copies. Institutions want originals, not photocopies. Banks, investment firms, Social Security, pension administrators, insurance companies, each may ask for its own. 2. Write down every financial account you can find. Bank accounts, investment accounts, 401k statements, pension documents, life insurance policies, car titles, mortgage paperwork. You are not solving anything yet. You are making a list. 3. If you need cash in the next 2 weeks, check which joint accounts you already have access to. Joint bank account with right of survivorship passes automatically to the surviving spouse, and you can use it right away. If accounts were in your spouse's name only, contact the bank. They have a process for this. They handle it regularly. That is all for the first 72 hours. Gather. Don't decide. About the first month, almost nothing is as urgent as it feels. People in grief are vulnerable, and some people know it. First 30 days is when you're most likely to be approached by someone who wants to sell you something. A new annuity, a consolidation plan, a life insurance policy. You're allowed to say, "I am not making any financial decisions for at least 90 days. Say it to anyone who isn't a lawyer or a court. 3 things that actually cannot wait. Notify Social Security. If your spouse was receiving benefits and passes away, those payments must stop. Month of death is not paid. And if your spouse hadn't yet claimed, and you are 60 or older, you may qualify for a survivor benefit. Call the Social Security Administration at 1-800-7772-1213 or go in person to your local office. Don't delay this one. Contact life insurance companies. If there is a policy, get the claim process started. Most companies are straightforward to work with. Ask them to send the forms and a list of exactly what they need, then work through it one item at a time. Contact the employer or pension administrator if your spouse had a pension. Survivor benefit rules vary. Some pensions stop at death. Some continue at a reduced rate. Some have an election window that closes within a fixed number of days. Everything else, what to do with the investment accounts, whether to sell the house, how to restructure your monthly income, can wait. 30 days is too soon for any of it. There's one more task in the first month that people almost always miss, and it matters. You have to protect your spouse's identity and your own. Here is the uncomfortable truth. An obituary is a public announcement, and a small number of people read them looking for opportunity. A recently widowed person, grieving and handling unfamiliar paperwork, is a target. So do 3 things. First, notify the 3 credit bureaus, Equifax, Experian, and TransUnion, that your spouse has died, and ask them to place a deceased notation on the file. This stops someone from opening new credit in your spouse's name. Contact one, and they are supposed to share the notice, but contacting all 3 is safer. Second, be careful with any call, email, or letter you did not start. Someone tells you your spouse owed a debt, or that you must pay a fee to release a benefit, or that you need to confirm account numbers. Stop. Legitimate institutions do not work that way. Never give an account number, a social security number, or a payment to someone who contacted you first. Third, treat the death certificates like keys because that they are. Each certified copy can open an account. Hand them only to institutions that require an original, and ask for the copy back when the business is done. None of this means living in fear. It means closing the doors before anyone tries them. A word on Social Security, because this is where survivors most often leave money behind. As a surviving spouse, you can generally receive your spouse's benefit, or your own, whichever is higher. Not both. 1. Check. If your spouse delayed Social Security to age 70 and built up a benefit of $2,800 a month, that is the check you can inherit as a survivor, if it is larger than your own. At age 65, the difference between the right claiming strategy and the wrong one can be more than $300,000 over a lifetime. Survivor benefits also have their own claiming rules, separate from your own retirement benefit. You can take a survivor benefit as early as age 60, even before you are eligible for your own retirement benefit. In some situations, it makes sense to take the survivor benefit early and let your own benefit grow until 70. 2 practical details people miss. There is a one-time death payment from Social Security of $255 paid to a surviving spouse who is living with the deceased. It is small, but it is yours, and you generally have to ask for it. You usually have up to 2 years to claim it. You cannot start a survivor benefit fully online. Unlike a regular retirement claim, you have to call Social Security or go into an office to apply as a survivor. So don't wait for a website to guide you. Make the call. One more warning. The payment for the month your spouse died usually has to be returned, even if it already landed in the account. Social Security will reclaim it. Don't spend that last deposit assuming it is yours. This is one of those decisions where a short, paid consultation with a Social Security specialist or a fee-only planner is worth every dollar. The difference between strategies can be $15,000 to $20,000 or more. Don't assume you know the right answer here. Verify the rules at sa.gov and get at least one professional opinion before you file any claim. All figures are based on 2026 rules. Social Security rules can change. Verify at sa.gov before making any claiming decision. Find these 5 documents before anything else. 1. Will. It tells you who is authorized to make decisions, what goes where, and whether a trust is involved. If you can't find it, check with any attorney your spouse worked with. 2. Beneficiary designations on every retirement account and life insurance policy. These override the will. Beneficiary form completed in 1997 still controls what happens to that account today, even if the will says something different. This is where estate mistakes usually live. 3. The most recent tax return. It is a complete inventory of your financial life, every account that paid interest or dividends, every income source, the names on every account. Start here. 4. Any trust documents. If your spouse created a living trust, the trustee, which may be you or may be someone else, controls what happens to assets held in the trust. You need to know what's in it. 5. Medicare and supplemental insurance records. Coverage does not automatically transfer. Know what you have, what it costs each month, and when your enrollment windows open. These 5 documents answer most of the questions you will be asked in the next 6 months. Here is what transfers automatically and what does not. Accounts titled as joint tenants with right of survivorship, which covers most joint bank and brokerage accounts, pass directly to you. You need a death certificate at the institution, but not a court process. Accounts with named beneficiaries, IRAs, 401ks, life insurance, also pass directly outside of probate. You'll complete the beneficiary claim form at each institution. Call them, tell them what happened, ask what they need. They will walk you through it. Accounts that were in your spouse's name only, with no beneficiary named, may need to go through probate before you can access them. Probate is a court process. It takes time, sometimes months. A estate attorney can guide you through it. The cost and timeline depend on your state and the size of the estate. Property, the house, the car, depends on how it is titled. Joint with right of survivorship, it passes to you. In your spouse's name only, probate may apply. None of this is designed to be cruel. It is just paperwork. Move through it at your own pace, with help. While the paperwork moves, ordinary life keeps sending bills. So spend an hour mapping your cash flow. Start with the automatic payments. Your spouse may have set up autopay for the mortgage, the utilities, the insurance, and a dozen subscriptions. And some of those may draw from an account that is about to be frozen or closed. If an account in your spouse's name only gets closed, every payment attached to it will start to bounce. A bounced mortgage or insurance payment causes real problems. So find every recurring charge and move the important ones, housing, utilities, health, and auto insurance, onto an account you control. Not rush to cancel things. It is tempting to cut every subscription and policy in the first week, but be careful. Not cancel the homeowners or auto insurance while you still own the home or the car. Do not drop a health plan until you know exactly what replaces it. Do not close a joint credit card that carries years of your own credit history. Pause, list, and change things on purpose, not in a panic. The goal for these first months is simple. Every essential bill is paid on time from an account you can see and control. That is enough. Taxes are the part almost no one warns you about, and they can cost you or save you real money. 3 things to understand. First, there is a final tax return. For the year your spouse died, you can still file jointly, as married filing jointly for that one last year. It is usually the lower tax option, so don't let anyone rush you into filing separately without a reason. Second, and this is the one that surprises people, is what happens the year after. Once you are filing as a single person, the tax brackets and the standard deduction are less generous than they were for a couple. The same income can push you into a higher bracket and a bigger Medicare premium. People call it the survivor's penalty. It is not a fee anyone charges you. It is just how the brackets work once there is one of you instead of 2. If you have a dependent child at home, you may qualify for a better status, called qualifying surviving spouse, for up to 2 more years. Ask a tax preparer which status applies to you. Third, there is a rule that works in your favor, and missing it costs money. When you inherit investments or a home, the cost basis usually resets value on the date of death. This is called a stepped-up basis. In plain terms, if your spouse bought a stock for $20,000 and it was worth $80,000 on the day they died, and you sell it soon after, you generally owe little or no capital gains tax because your starting point is the $80,000, not the $20,000. That can save you thousands. So before you sell anything you inherited, find out its value on the date of death and keep that record. Tax law is specific, and it changes. Confirm all of this with a tax professional or at irs.gov before you file or sell. At some point in the first 90 days, you'll want professional help. Here's how to tell the difference between the kind that's actually useful and the kind that isn't. A fee-only financial planner charges by the hour or by the project. You pay them directly. They have no financial product to sell you. Search for CFP professionals with fee-only status at napfa.org, the National Association of Personal Financial Advisors. The other kind sometimes arrives before you've even asked. Call because they saw the obituary, or they were your spouse's broker, or a neighbor referred them. They are warm and sympathetic. They may also earn a commission when you move money. I am not saying they are bad people. I am saying you should know how they are paid before you sign anything. One question to ask everyone who wants to help with your finances right now: how are you paid? If the answer is unclear or involves products, or they seem to want you to move money quickly, say, "I'll need a few more months before I make any financial decisions." That sentence is sufficient protection for this period. Around the 2 to 3 month mark, you've done the urgent work. What remains is simpler: consolidate. Most people in this situation find they have accounts scattered across several institutions. An old 401k at a former employer, an IRA at one brokerage, a savings account at a bank across town. Moving everything to one institution makes the whole picture easier to manage. Do this as a direct transfer, institution to institution, not as a check made out to you. When money moves directly from one custodian to another, there is no tax withholding, no 60-day clock, no risk of a paperwork error that triggers a tax bill. If you are consolidating inherited retirement accounts, the rules are slightly different for inherited IRAs, so confirm the process with the receiving institution first. Goal at 90 days isn't to have everything figured out. It's to know what you own, what life costs, and to have one trusted advisor who charges a flat fee for their time. Before we close, here is a short list of decisions that feel urgent and are not. Give each of them a year if you can. Selling the house. Grief is a poor time to make a permanent move. Unless you truly cannot afford to stay, wait until your head is clearer. Moving in with adult children or lending them large amounts. The impulse to reorganize everyone's life at once is strong. Slow it down. Buying anything complicated that someone is selling you, especially annuities or new insurance. If it is truly the right move, It will still be the right move in 6 months after a fee-only planner has looked at it. Making large gifts. It is generous, and there may be a time for it, but not in the first raw months. Here is a simple rule. If a decision is permanent and it can wait, let it wait until you are steadier. The small, reversible steps you take now are enough. Patricia called me about 6 months after we first spoke. She had found all 5 documents. She had worked with a fee-only planner for 2 paid sessions. She had called Social Security and learned her survivor benefit was $400 a month more than she had been getting, money that had been sitting unclaimed since February. She had consolidated 3 accounts into one. "I still don't understand all of it," she said. "I understand enough, and I know who to call when I don't. That's the finish line, not mastery, just knowing enough and having one person you trust." If you're in this situation now, here is the short list. Order 10 death certificates. Write down every account you can find. Call Social Security. Notify the credit bureaus. Find those 5 documents. Keep the essential bills paid from an account you control. And don't sign anything from someone you don't already know for at least 90 days. You don't have to become a financial expert by Thursday. Just take the next right step. Run your numbers. Know you're on track. All figures and rules in this video are as of 2026. Social Security rules, tax laws, and Medicare enrollment windows can change. Verify current rules at sa.gov, ers.gov, and medicare.gov before making decisions.